World stock markets nosedive today. $4 trillion investor wealth has been wiped off in just past 8 days when stocks were at a record high. Europe stock exchanges started down as much as 3%, prompting investors to turn towards gold. The stock sell-off had been viewed by some as a healthy correction. Wall Street's Dow Jones and S&P 500 benchmarks had slumped 4.6% and 4.1%. Yesterday, their biggest drop since August 2011. It was also the Dow's biggest fall on a pure points basis of all time. In Asia, MSCI's broadest index of Asia Pacific shares outside Japan slid 3.4%. Taiwan's main index lost 5%, its biggest since in 2011, and Hong Kong's Hang Seng index dropped 4.2%. Japan's Nikkei dived 4.7% to 4-month lows, its worst fall since November 2016. The original trigger for the sell-off was a sharp rise in U.S. bond yields late last week after data showed U.S. wages increasing at the fastest pace since 2009. That raised the alarm about higher inflation and with it potentially higher interest rates. In India, BSE Sensex ended 1.6% down at 34,195. Nifty closed 1.5% lower at 10,498. The world stock markets have nosedived. $4 trillion investor wealth has been wiped off in just past 8 days when stocks were at a record high. Europe stock exchanges started down as much as 3%, prompting investors to turn towards gold. The stock sell-off had been viewed by some as a healthy correction. Wall Street's Dow Jones and S&P 500 benchmark had slumped 4.6%. So what exactly are the reasons behind this bloodbath in the global and Indian markets? Record fall in Dow Jones Index over last decade triggered the fall. Bond yields inflation is up in US, raising concerns among investors. Fresh US wages data was recently released. As new US Fed chairman took over, there were concerns about a more hawkish policy in the US. Massive sell-off in global markets also affected Asian markets. Overdue correction and low investor mood after Indian budget are also being attributed as the reasons. Joining me on the broadcast is market expert Anisha Nair Dhawan. Hello, Ms. Dhawan. Literally a bloodbath going on as far as markets are concerned all across the world. What do you make of this, ma'am?
Well, what happened today is synchronized a global sell-off of all risk assets. What are risk assets? Largely equities. We've even seen a meltdown in Bitcoin. Bitcoin and equities are seen as risk assets, and not so risky assets are gold and the dollar. So what has led to this? A lot of people will say there's one thing called gravity. Gravity is responsible for what we are seeing across the globe, because for a large amount of time we have seen global markets rise in a unidirectional fashion. We haven't really seen a significant correction, and the correction has finally come just because the weight of the markets was too much. What really transpired was a sell-off that started in the US markets, and what led to the sell-off? Good news became bad news, and come Monday, bad news became panic. On Friday, the US jobs report showed a strong addition of 200,000 jobs plus wage growth of 2.9%. This led to fears that inflation is on the uptick in the US, and the US Federal Reserve has been behind the curve when it comes to raising interest rates. They've already done rate hikes, and everyone is penciling in more rate hikes. The bond yield surged on Monday to 2.8%, which led to a sell-off in stocks. Now, this transpired across the globe. In Asia, we saw deep cuts. Our markets, the Sensex and the Nifty, opened with cuts of more than 3%. At close, they recovered a fair bit, closing cuts of 1%. But now we are seeing selling pressure continue in Europe. The US futures in the earlier half of the day were pointing to a negative start. They have also recovered. So at this point in time, it may be a little too soon to say whether the correction has ended. Have we found a bottom? But one thing we can say for sure, that risk assets are certainly not something that people want to dig into very soon.
Money has been wiped off the markets, particularly in India, and how worried the Indian investors should be.
Well, if you speak to market experts, a lot of them advise that there is no need to worry, there is no need to panic. The fundamentals of the Indian markets remain strong. Growth is on an uptick, which is very contrary to what we're seeing in the US. We've seen growth continuing for a long time. There could be a slowdown there. It's completely opposite of what is happening in India. We're at the cusp of strong growth picking up. Inflation so far has been under control. It is going up. The government has again reiterated its commitment to keeping the fiscal deficit under check. And domestic flows, what you put into your SIPs, have remained strong so far. So there are really no big reasons for concern. Yes, because of the global market sell-off, our markets too have sold off. But if you speak to the experts, they feel that there is no need to panic for Indian investors. They should be a little patient. In the long term, the fundamentals will play out, and this correction will also be behind us.
Thank you, Anisha Nair Dhawan, for joining us with that comprehensive update.